All right, let's jump right into this explainer and equip you with what is essentially a field manual for navigating the notoriously complex, high-stakes wilderness of the U.S. tax system. Because whether you're advising clients, running a business, or honestly just trying to protect your own bottom line, tax is the one constant variable that touches absolutely every financial decision you'll ever make. We're going to take this massive, intimidating subject and break it down into a structured framework. That way, you can stop just reacting to the terrain and actually start strategizing. So here's our roadmap. We'll start with the terrain, move on to choosing your avatar, break down the mechanics of survival, point out some major traps and hazards, and finally, look at navigating the global context. Part 1. The terrain. Look, tax is everywhere. It is absolutely not an isolated silo that you can just toss over to the accounting department. One of the most unique and frankly painful aspects of the U.S. system is that we're dealing with three distinct overlapping layers of taxation: federal, state, and local. Unlike a lot of countries where you just deal with one national tax authority, here you're answering to multiple masters all at once. Let's take a business in San Francisco as an example. They don't just pay a 21% flat federal corporate rate. Nope. They're also getting hit with an 8.84% state income tax and $800 state franchise tax, and on top of the whole shebang, city-level, local gross receipts taxes. You literally have to account for all three of these layers simultaneously to understand your true costs. If you're only looking out for the federal predator, the local ones are going to eat your profit margins alive. Now, there is a strict hierarchy of rules to navigate here, and a really common misconception is that the IRS actually writes the tax laws. They don't. They just administer them. It's Congress that writes the Internal Revenue Code, which is your supreme primary authority right under the Constitution. When you're looking for a safe harbor, you have to know what actually holds up in court. Treasury regulations, those are legally binding. But things like IRS FAQs or private letter rulings, well, those are persuasive, but they aren't legally binding on anyone except the specific taxpayer who originally asked for them. You've always got to know where your advice sits on this pyramid before building a strategy around it. Moving to part 2, choosing your avatar. When you step into this wilderness, the absolute most critical structural decision you make on day one is choosing your business entity type. It dictates everything that follows. It's your primary armor. So let's look at a crucial question, one that highlights a surprisingly common senior-level mistake. Which structure actually gets taxed twice on the exact same income? It's the C corporation. They face what we call double taxation. It works like this. First, the corporation pays a flat 21% federal tax right at the entity level on whatever earns. Then, when it distributes those after-tax profits to shareholders as dividends, those exact same dollars are taxed a second time on the shareholders' personal returns. Pass-through entities, on the other hand, so your sole proprietorships, LLCs, partnerships, and S-corps, they dodge that entity-level federal tax entirely. The income literally passes right through the business directly to the owner's personal returns, where it's taxed just once. Choosing the wrong avatar here, that can unnecessarily bleed millions of dollars from an otherwise successful enterprise. Part 3. The mechanics of survival. Let's talk about calculating exactly what you owe. So breaking down the actual math, think of it like a funnel. You start at the very top with your all-encompassing gross income, basically everything you make. Then you subtract above-the-line deductions. That gets you to your AGI. From there, you pull out either your standard or itemized deductions. Now, if you chose a pass-through entity, like we just talked about, you might also get to subtract a qualified business income deduction, or QBI deduction, which is this massively valuable tax break designed for small business owners. Finally, you reach the very bottom of the funnel, taxable income. This is the actual final number your tax rates get applied to. Now, I really want to anchor on AGI for a second because it acts as the absolute gatekeeper for the entire individual tax system. AGI isn't just some random subtotal. It determines whether you're eligible for traditional IRA deductions. It dictates whether you can actually deduct medical expenses, because those only count if they exceed 7.5% of this specific AGI number. It even impacts child tax credits. Managing and legally lowering your AGI is often the single most important tactical goal of individual tax planning, simply because it unlocks a whole cascade of other shelters down the line. Okay, once you have your taxable income, you apply the rates. But we really need to bust a huge misconception about how progressive tax brackets work in the US. If you're in the 37% tax bracket, you do not pay 37% on all your income. No way. You only pay that top rate on the specific dollars that actually fall into that highest bracket. Think of it like filling up a row of buckets. Your first dollars fill up a 10% bucket, the next dollars fill a 12% bucket, then 22%, and so on. If you earn exactly one single dollar into that 37% bracket, you are only paying 37 cents on that one specific dollar. And because of those progressive buckets, you always have to calculate two different rates for yourself or your clients. Your marginal rate is that highest bracket we just talked about, the rate applied to your absolute last dollar earned. But your effective rate is your total tax paid divided by your total overall income. The effective rate is always lower, and it represents the true, meaningful percentage of your wealth that's actually going to the government. Whenever someone asks, what's my tax rate, the effective rate is the number that really impacts their real-world cash flow.
Part 4. Traps and Hazards, the stuff that keeps us up at night.
100%. That is a jaw-dropping, terrifying number. It represents the trust fund recovery penalty. This gets triggered when an employer willfully fails to collect and remit employee payroll taxes to the IRS. We're talking federal income tax withholding and FICA, the mandatory taxes that fund Social Security and Medicare. This is arguably the most dangerous hidden predator in the entire tax code. Why? Because the IRS defines the word willful incredibly broadly. If you know payroll taxes are owed, but you decide to pay a key vendor or keep the lights on by paying rent instead, the IRS considers that willful. And the scariest part is that this penalty completely pierces the corporate veil. It holds bookkeepers, directors, and officers personally liable for 100% of the unpaid amount. The company going bankrupt, yeah, that will not protect your personal checking account or your house from this penalty. Next up, a literal ticking clock. $13.61 million. That's the massive 2024 individual lifetime exemption for estate and gift taxes, allowing substantial wealth to transfer completely tax-free. But you absolutely cannot ignore the sunset provisions of the Tax Cuts and Jobs Act. After 2025, unless Congress intervenes, this historically high exemption is scheduled to plummet by about half, dropping back down to roughly $7 million. High net worth individuals have a very specific, rapidly closing window to utilize this shelter before the whole landscape shifts. And finally, Part 5, Navigating the Global Context. The U.S. is basically a lone wolf here. It's an absolute structural outlier because it uses citizenship-based taxation. Almost every other country on Earth taxes based on residence, meaning where you physically live and work. But a U.S. citizen living in London for 20 years, they still have to file an annual U.S. tax return on their worldwide income. This brings in intense international complexities, like massive reporting requirements for foreign bank accounts under strict laws like FATCA and FBAR. Basically, these rules are designed to ensure the IRS knows exactly how much money you have parked overseas. Miss an FBAR filing just because you didn't know about it, the penalties can be completely devastating. And it doesn't stop there. The U.S. also has absolutely no federal consumption tax. There's no national value-added tax or VAT, which is pretty standard across Europe and most developed nations. Instead, businesses in the U.S. have to navigate this incredibly fragmented web of 45 different state sales tax systems, plus thousands of local variations. If you're selling online across the country, tracking economic nexus, which means figuring out which states you've sold enough in to trigger a tax obligation, is just a massive ongoing compliance nightmare. Look, when you inevitably need help navigating all of this, you have the right to retain a trusted guide. You essentially have 3 options for practitioners with unlimited practice rights before the IRS. You've got CPAs, who provide a broad tax and accounting scope, really looking at the big picture. You have enrolled agents, or EAs, who are IRS-credentialed specialists and often incredibly cost-effective for audit defense. And then you have tax attorneys, who offer that crucial element of attorney-client privilege for complex, high-risk, or potential criminal disputes. Remember the Taxpayer Bill of Rights. If you retain one of these pros, you never actually have to speak directly to an IRS agent ever again. Your rep steps in and handles it for you. As we wrap up this explainer, I want you to consider this for your own business or your clients. Tax isn't just some annoying annual paperwork chore. It is an active, year-round strategic environment. Understanding the rules of the game is truly the only way to survive and thrive in this landscape. So the question is, are you proactively strategizing to protect your wealth, or are you just waiting out there in the wilderness for the bill to arrive? Thanks for navigating the train with us.